Hey, Billy Applehart here, and author of Money Mastery, where we like to talk about making sense of making money for making a difference. And so we've been having an exciting time talking about the 14 mistakes that real estate investors make. And today we're going to actually pick up with mistake 14. But before we do, let me take a minute to tell you about my new book, Money Mastery. You can actually order it online at Amazon. You can get an actual digital copy, like in a Kindle version, or you can actually get the hard copy. Now you can see it's a pretty thick book. And in here, since we're talking about 14 mistakes that typically every new investor makes, in here I cover some really powerful truths about real estate and some things that'll help you know what markets to buy in and that kind of thing. So if you haven't got a copy, I want to encourage you to go on and help me out, buy a copy. But also, if you have read it and you enjoyed it, I'd appreciate you going on Amazon and actually giving us a good review for the book, just to let you know. So let's talk about mistake 14 real quick that every new investor makes, and that is not clearly identifying your exit strategies. Now I want to tell you, this is a really common mistake that new investors make. And I'll give you an example of what I mean. The first thing that happens is not really understanding what I call the broad, high-level, 30,000-foot exit strategy. So you have to know, if you're going to buy a piece of property, are you going to buy it and flip it? Are you going to buy it and rent it? So in other words, and then there are some people that buy and rent one bedroom at a time, or they buy and have other types of broad exit strategies that they use. What's important that I want you to see and understand is that really, to be a really successful real estate investor, you really need to know how to do the first two, which are the big, broad, high level 30,000 foot ones. You've got to learn how to buy and sell properly. I always like to say it like this: you make money when you buy, not when you sell. So in other words, you've got to get the proper deal going in, and then you have to have correct techniques and systems in place to be able to sell and flip out and in a quick way, so you can get a quick turn on your money. If you're going to buy and rent, then obviously you need to know how to manage. First of all, you remember you make money when you buy, and then when you begin to rent, you got to make sure you know how to literally manage the property or have someone do that for you. You have to understand all the things about learning how to rehab and the different things in both of these particular strategies. But today, we're not really going to focus on just the high levels. I'm going to kind of give you some specific strategies, and for those of you that are even sophisticated investors, hopefully this will help you a little bit. I like to say this in the seminars that we hold, the different workshops that we do, or roundtables. I like to say this: if I could show you how to make $100,000 a year tax-free. Now, I actually talked about that a little bit earlier, but I want to do this here with exit strategies. If I could show you how to make $100,000 a year tax-free, if I could show you how to do that, and for the rest of your life, would you like that? Most people go, oh yeah, I'd like to know that. So today, it's really simple. If you bought, for example, let's say 3 houses a year for 10 years, you would have 30 houses, right? Single family homes. And in this case, we're going to say, because this is one of the formulas we teach, that you're going to have a positive cash flow of $300 per house. So if you take that and add it, or multiply it, you have 30 houses, you have a positive cash flow per house of $300. That's $9,000 a month. That's pretty good. You multiply that times 12, that's $108,000. Now if you take each one of those homes and depreciate them by the number that the IRS allows us to appreciate properties by, or to depreciate properties by, then basically you cover all of your positive cash flow just with what's called a phantom loss. It's the depreciation on that. The house doesn't really go down in value. What happens is the house continues to go up in value, but the IRS allows you to depreciate it about 1/27th a year on a single family house in the US. And so all of your basically positive cash flow income is covered, so you don't owe any taxes. And then when you get to the very end of it, you take all of those properties that you have and the different strategies you use, and you put those, you move those through what we call into a charitable remainder trust, or you can literally, before that, you can do a 1031 exchange on some other kind of properties as you continue to snowball up. And then at the very end, you can move all of that into what's called a charitable remainder trust. And when you do that, it's very effective for basically not having to pay taxes. Now I want to be clear here, okay? It's really a tax deferred strategy, not necessarily a tax-free strategy, but for you in your life, it's tax-free. And for your heirs, if you put it into a charitable remainder trust, then it remains to be tax-free, so to speak. So I just want to share that with you as the first strategy. And you say, you know what, I don't want to have 30 houses. Okay, another way to do it is you can buy, say, 20 houses, and let's say you buy 3 a year. Let's just say single family homes. It takes you 6 or 7 years to do that, somewhere in there. And then one of the things you do is you hold those for, let's say 10 years. Wow, that's a long time. I know. Let's just say you hold them for 10 years. You got 20 houses, right? So here's what you do. In 10 years, you sell 10. You pay off the first 10. They're already way down. You've already paid them. Your renters have already paid the principal down quite a bit already. And now you've got 10 houses that are paid off. That's a pretty good place to be. If you have 10 homes that are paid off, and let's just say that positive cash flow on those houses is $1,000 a month, that's $10,000 a month. You still get depreciation. I'm telling you, it's a powerful place to be. Now, another way to do it, and I really like this strategy, is let's say you decide to purchase one house per year. Okay, just one investment property. So you purchase that house, and each year for 12 years you purchase one house. Now you have 12 houses, okay? In year 13, you don't buy any more houses. You're going to start living off of it, and here's what you do. You go back in year 13 to house number 1 that you bought right. Remember, you make money when you buy, right? You go back to house 13, you don't sell it, you refinance it, and you pull the equity out of that house. Make sure you still maintain the cash flow formulas that we teach you when you do that. But let's just say, for illustration purposes, you were able to take $75,000 out of that house because it had appreciated that much in that 12 years of time. Let's just say that, okay? So now you take $75,000 and you put it in your pocket. And the question that I always ask people, do you have to pay taxes on that $75,000? The answer is no, it's tax-free. Tax-free, what do you mean? Well, it was a loan. You borrowed it out of your house. Now you put it in your pocket. Now, I will admit, young people, if I have some of those, say millennials watching today, you may think, well, taxes are not a big deal because you're just paying it out of your, out of your paycheck, and you've learned to adjust. Well, I understand if that's where you are, but people who are learning to live off their money, having $75,000 a year tax-free is major. That's a major deal. Because here's what happens. A lot of people will retire with $1 million in the bank, think they're going to make $100,000 a year, and they don't. What they end up doing is they make maybe $60,000 off of the million, and then they end up paying taxes of somewhere in the 20% range at a minimum. So their livable, their actual able to spend money is a lot less. So being able to take $75,000 tax-free, let's say every year. Now, I know the next year you may only take 50, or the next year, the third year, it may be 60. But the point is, it's a good strategy if you have other forms of income in your life, Social Security, whatever you have, if that's what you want. But we're talking about financial independence. So really identify your exit strategy, because it will tell. I have one friend who every property he buys, sometimes he buys as many as 10 a year, he puts them on a 15-year note. And I remember when he turned 55, he had a ton of really nice 3-bedroom, 2-bath brick homes, put them on a 15-year note, let his renters pay them off. And he had something like 50 of those type of properties paid off. And he was renting those somewhere in the neighborhood, the part of the country he was in, for about $1,400 a month. I mean, add it up. Add it up, that's $50,000 a month, $60,000 a month he had coming in. By the time he paid his man, he was still putting $30,000-$40,000 a month in his pocket. Now I know you can live off that. So today we're just simply talking about the mistakes, not identifying your exit strategy. So think clearly about what it is you're trying to do with your investment. I'm only giving you a few ideas here today. And listen, I really appreciate you watching the blog. If you wouldn't mind, if you have a question about what I just talked about, or you'd like to make a comment, we really appreciate you hearing from you, and also to share it if you think some other people would benefit from it. So thanks for tuning into the blog, and we'll see you right here again next week. Hey guys, I want to tell you, if you enjoyed what we covered here, right here, if you've enjoyed this, here's some bonus mistakes. So tune in next week as I share these bonus mistakes with you. We'll see you next week.